In today's video, we're going to cover 15 facts about required minimum distributions, otherwise known as RMDs. These 15 facts can help you delay RMDs, minimize the negative effects of RMDs, and avoid costly mistakes. Let's get into it. For those that aren't familiar with required minimum distributions, these are mandated withdrawals that you must take from your tax-deferred accounts once you reach a certain age. Because withdrawals from your tax-deferred accounts are fully taxable, these forced withdrawals can become quite costly and increase your tax bill significantly. The amount that you are mandated to take is based off your age, and the older you become, the more you are forced to withdraw. To figure out your RMD on an annual basis, you take the ending balance of your tax-deferred accounts on December 31st of the previous year. Then you look up the life expectancy factor in the corresponding RMD table, and you divide your balance by this life expectancy factor. But enough with the basics. Let's jump into these 15 lesser known RMD facts. First, the current RMD age is 73, but this will only remain the RMD age for those that turn 73 before the start of 2033. Or said another way, if you were born between 1951 and 1959, you will need to start RMDs in the year you turn 73. For anyone born in 1960 or later, the RMD age skips a year and becomes 75. In the last couple of years, there have been some major shifts around RMD starting ages, and it's likely these ages will not change for the foreseeable future. Fact number 2. Many retirees don't know this, but there is more than one RMD table, and making sure you are using the most beneficial table for your situation is extremely important. Now, the vast majority of retirees will be subject to the uniform RMD table. If you are single or married with a spouse of a similar age, you will use this uniform table. However, if you have a spouse that is more than 10 years younger than you, and your spouse is the sole primary beneficiary, then you are eligible to use the Joint Life and Last Survivor RMD table. Now, why would you want to do this? Well, remember that to figure out your RMD, you divide that ending year balance by the RMD factor. This means the larger the RMD factor, the smaller your RMD will be. As you can see, the joint table offers a higher RMD factor at every given age. Now, with this slide, I'm just giving a snapshot of what this table might look like for a couple with a 12-year gap. But know the RMD factor is based on a grid table, where you find that RMD factor based on the intersection of both of your ages in that given year. Again, a higher RMD factor is better here. Fact number 3, RMDs start in the year that you turn your corresponding RMD age, but you actually don't need to take your first RMD here. So if you turn 73 in May of this year, let's say, you will begin RMDs this year and obviously moving forward. But in this first year, you actually aren't required to take that first RMD. You technically have until April 1st of the following year, or in 2025 in this example, to take your first distribution. Now, keep in mind, this is only a rule for the first year. In every preceding year, you will need to take that RMD within the calendar year. But again, you gain some leeway with this first RMD. The key thing to note here is if you wait until the next year to take your first RMD, you'll actually have to take 2 RMDs that year. One for 2024 and one for 2025 in the example on the screen. Fact number 4, you don't need to sell out of a position in your IRA and then take the cash to satisfy your RMD. You can actually take what's called an in-kind RMD. In-kind means you transfer shares into a taxable account rather than taking a cash distribution. Let's say you are 78 and you are not in need of your RMD. You are simply planning on taking that RMD and reinvesting it. Rather than selling shares, being out of the market for a few days and then reinvesting, you can simply transfer shares into your taxable account and remain fully invested through that transfer period. The thing to note here is that if you do a full in-kind transfer, then you'll need to make quarterly estimate tax payments. For our clients, I recommend withholding taxes from the RMD and then in-kind transferring the rest of that RMD to make taxes a bit easier. Number 5, some RMDs can be aggregated together while others need to be taken individually. Let's say you have a few tax-deferred accounts. You have a 401k, maybe your spouse has a 403b, and then you have a few IRAs at multiple custodians. Do you have to take an individual RMD from all of these individual accounts, or can you combine some of them? These are called aggregation rules, and here's essentially how they work. Because tax-deferred accounts are individual accounts, you will always need to take a separate RMD from your spouse if you're in a couple. You cannot aggregate together accounts in a couple. From there, you can aggregate together RMDs from IRAs. So in this example, John could add up all of his IRA RMDs and take one big RMD from one IRA, rather than taking 3 separate RMDs. 401ks cannot be aggregated together, and you will need to take an individual RMD from each 401k. 403Bs, however, can be aggregated together, but you need to specifically take that RMD from a 403B. Because it can be hard to keep track of all of these aggregation rules, all things being equal, I recommend retirees consolidate as much as possible. The easiest way to keep track of RMDs will be to roll over all of your tax-deferred accounts into one IRA, and then you only have one RMD for your situation. I have a video right here that can review all the reasons it might make sense to do a 401k or 403b rollover. Number 6, RMD penalties used to be incredibly aggressive. If you made an RMD mistake and forgot to, let's say, take your RMD, you were hit with a 50% penalty. So let's say you forgot to take a $10,000 RMD. Not only did you have to take that RMD later, but you also owed a $5,000 penalty. Now, this was a very unforgiving penalty. Well, as part of the latest Secure Act 2.0 bill, they lowered this penalty to only 25%. In fact, it can be lowered to as little as 10% if you fix the problem within 2 years. Now, this is still a penalty you want to avoid if possible, but it's certainly a more minor penalty relative to the old, more aggressive 50% penalty. RMD fact number 7, once you reach age 70 and a half, a new opportunity opens up for you to efficiently give money to charity in the form of what's called a qualified charitable distribution, otherwise known as a QCD. A QCD allows you to take your annual RMD up to $105,000 and give it directly to charity, thus eliminating it from your taxable income. The reason this charitable strategy is superior to just a straight charitable gift is that it is classified as an above-the-line deduction, meaning you don't need to itemize deductions to gain a tax benefit here. Using a QCD allows you to give away your RMD, and the IRS will basically treat it as if you never had that RMD. If you are over 70 and a half, given to charity, and not using a QCD, you're missing out on a great charitable strategy. The one thing to note here, you can't QCD from a 401k, only from IRAs. So this is another consideration in a 401k to IRA rollover. Number 8, if you're someone who wants to work later into life, or you want to work part-time in retirement, you may be eligible to delay RMDs indefinitely with something called the still working exception. This exception specifies that you do not need to take an RMD from the 401k of your current employer, even if you are past the RMD age, as long as you're still working for that employer. It's important to note this exception only applies to the company plan of your current employer, but many 401ks will allow you to do what's called a reverse rollover, which means you could roll over your IRAs into that company plan and avoid RMDs altogether. The nice part about this is that there's no minimum hours per week that you need to work. As long as you're eligible for the 401k, you apply for this still working exception. The kicker here, if you, your child, or your grandchild owns at least 5% of the company, well, you're not going to be eligible for this exception. Number 9, when a spouse passes, you need to decide what to do with their tax-deferred accounts. There are a few options you have to avoid or minimize RMDs. The first 2 options involve you taking ownership of your spouse's accounts. You can do this by either rolling over their IRA into your IRA, or you can simply retitle their IRA as your IRA. This will make the most sense when you are younger than your spouse. Say your spouse is 75 and taking RMDs. You are 70 and not yet subject to RMDs. Rolling your spouse's accounts into yours can delay RMDs a few more years. The third option involves you staying as a beneficiary on the deceased accounts. Say you are 75 and your spouse passes away at age 70. If you roll over their IRAs, well, you will have to start taking RMDs. So it can make sense to remain a beneficiary on the accounts rather than roll them over and combine into your IRAs. The beneficiary status can be advantageous in other situations as well. Say you are 55 and your spouse passes away this year at an age of 62. If you roll over that IRA, well, now you're going to be subject to the 59.5-year rule. If you stay a beneficiary, however, you can avoid this 59.5-year rule and withdraw from that inherited IRA. Fact number 10, for those that are wanting to spend down their retirement portfolio, instead of leaving a ton of money to the next generation, the RMD tables can actually be a reasonably good guide in showing you how much you can reasonably spend. Required minimum distributions were designed to exhaust your portfolio if you live long enough for those RMDs to grow large enough. So by using RMDs as a guide for withdrawals, you will do a better job of spending down your portfolio on average as compared to more static withdrawal-based methods. In fact, Morningstar recently published a paper on this withdrawal method that I walk through in this video right here. When compared to a common static-based withdrawal method like the 4% rule, using required minimum distributions as a guide for retirement withdrawals can raise your lifetime withdrawal rate by 35%, allowing you to utilize more of your wealth to benefit your retirement. The biggest downside to using RMDs as a withdrawal guide is that distributions can be quite volatile year to year. RMD fact number 11 is important to understand both as you potentially inherit assets yourself or you pass money on to the next generation. Let's say that you pass away in March of a given year. The IRS rules mandate that an RMD is taken regardless of passing away. But when you take that RMD, it may have a significant tax ramification. If you take the RMD before you pass away, that RMD goes on your tax return. If you have not taken that RMD at passing, your heirs must take the RMD and it goes on their tax return despite being your RMD. For this reason, I typically recommend most retirees take their RMD earlier in the year. Take a situation where you pass away in the first half of the year. It's unlikely that you will have much income on your tax return because, well, you passed away earlier in the year. You didn't have to take income for the full year. Given this, it's likely that RMD will have fairly preferential tax treatment because it will fill your lower brackets. On the flip side, if you wait until later in the year, the responsibility may be on your heirs. They may not understand these convoluted RMD rules and may risk a penalty if they miss that RMD altogether. They may be showing a ton of income for whatever reason, and that may be a fairly expensive RMD to take. So in general, simplify things and take your RMD a little bit earlier. Number 12, know that RMDs don't just affect your life. Your heirs will also have RMDs. Let's say you pass away at age 80. You are in the midst of taking RMDs, and for the sake of this discussion, let's say you pass on a $500,000 IRA to your daughter. Current inherited IRA rules mandate that your daughter will have 10 years starting the year after you pass away to fully withdraw and exhaust that inherited IRA. So if you pass away this year in 2024, the 10-year window starts in 2025. Not only that, however, but she will also have to take an annual RMD each of those 10 years. Now, this matters greatly in tax planning. If we want to overly simplify this 10-year rule, if your heir were to spread out distributions as equally as possible across those 10 years, they would have to take something like 10% of the starting balance plus a little bit of growth each year. Given this, unless you are over the age of 90 when you pass away, the RMD withdrawal rate your heirs will have will be much larger than your withdrawal rate, meaning you are potentially passing on a bigger tax liability to your heirs at death. The last couple of facts are pretty quick ones. Number 13, in previous years, Roth 401ks had an RMD just like your normal tax-deferred accounts. This was the only Roth account to have formal RMDs. However, as part of the Secure Act 2.0, this RMD was now eliminated. And now no Roth accounts have RMDs outside of inherited Roth accounts needing to be fully withdrawn inside of that 10-year window. Number 14, in certain situations, not all of your RMD is taxable. Let's say throughout your working career, you made too much to contribute to a Roth IRA. So instead, you contributed to a non-deductible IRA in order to try to do a backdoor Roth. For whatever reason, you weren't able to initiate that Roth conversion to finalize the backdoor Roth. And now you're in a situation where part of your IRA is pre-tax and part of your IRA is post-tax. Well, at the end of the year, the portional interest between your pre-tax and post-tax amounts inside your IRA will control just how much of your RMD is actually taxable. Say you have 85% pre-tax and 15% post-tax. Given a $58,000 RMD, $49,300 will be taxed at ordinary income rates and be fully taxable. And $8,700 will be considered a post-tax distribution, which means it will not be taxable. Then finally, fact number 15, the IRS has made it so you only have a few options for what you can do with your RMD. You can withdraw it and live on it. You can withdraw it and reinvest it or in-kind transfer it. You can give it to charity through a QCD. And even in some cases, you can withdraw it and recontribute it to another account if you qualify. Now, we get these questions quite often. Are you able to Roth convert your RMD? Are you able to roll it over into another IRA? And the answer is no to both of those. You are not able to Roth convert your RMD. You are not able to roll it into another IRA. This means that you need to plan ahead of the start of RMDs and build a game plan for how to avoid and minimize RMDs so they aren't a tax burden to your retirement. Now, the best way to avoid RMDs altogether is strategic Roth conversions earlier in retirement. The problem is there's a lot of BS and long-term mistakes people make in planning for Roth conversions. Click on this video right here where I talk about 10 of those common misconceptions. Again, click on this video right here, and always remember, you don't need more money, you need a better plan. Thanks for watching today. We'll see you in the next video.